Hello and welcome to the Weekend Investing Daily Bite of 27th of December. After 3 dull days, there was hope that the market will get out of this range, and it did in the morning, but it collapsed back upon itself. So, yet another day of almost nothingness, I would say. The market is completely in year end celebratory mode, so not much is expected right now going forward till the next move comes through. Today's topic is about ignoring strong warnings from index committees, how index gets rebalanced, and what kind of stocks are exiting the index, what kind of stocks are coming into the index. A lot of it can be made out just by looking at those stock charts as to what has been the formation of those charts going out, what has been the formation of those charts going in, and you would get significant amount of insights based on that. So we will look at that in the second half of the video. Of course, please read all the disclaimers and subscribe to the channel if you haven't so far. You can see very clearly here the Nifty tried to break out of this range, 3-day range. The 3-day top was broken out, went to 23,938, and then collapsed back on itself very near yesterday's close at 0.27%. No harm done, but nothing gained as well. So just buying time right now, trying to get over with this current calendar year. However, Nifty Next 50 almost closed at the lower end of the last 4 days of session. This certainly is not looking good, 0.88% down on Nifty Junior. And it seems that those 3 days was basically consolidation, and now the continuation towards the down probably has started for Nifty Junior, and there is a gap here which is yet to be filled. So that probably as soon as we break down below this 5-day low now next week, there is likelihood that we will go at a lower range. In the mid cap space, again, it was very dull, 0.12%, and now fifth close within the same time period, same range. So mid caps are still holding on, not yet given up on that range. Small caps also holding on 0.27%, not really going anywhere, and ending with a slight range bound day. Bank Nifty 2 did not really do anything. We are playing within the range of the previous day, so an inside bar on Bank Nifty, which really reflects that there is no momentum either way, up or down on Bank Nifty. 0.27% on that. On CNX 500, absolutely even distribution of advances and declines, 251 to 242. So here also you can see that it was very evenly distributed. On the Nifty heat map, quickly you can see there were sporadic greens in Mahindra and Mahindra and Dr. Reddy's, but and some losses in SBI, Coal India, ONGC, BEL, but others remaining reasonably stagnant. Nifty Next 50 was full of red, so Siemens starting to continue its fall along with ABB. You also had Vedanta, Gas Authority, JSW Energy, REC, PFC, all losing ground. Zydus Life and DMart along with Adani and Sol were the only sort of green spots in the Nifty Next 50 space. In the sectoral trends, pharma, along with autos that have been doing well for this last few days, were the leaders for the day. Pharma is now up 5.4% for the month, which is the highest gain for the last 1 month in any sector. So pharma is gradually picking up, and in fact, over the last 12 months, pharma is almost now the top gainer in terms of sector. So you can see how a dark horse pharma stocks, which were not really performing well last year, how suddenly now the sector has started to perform. Autos are now starting to come back, 1% on the day to day and 2.3% for the week. For the month gone by, only minus 1.8% down there, and for 12 months are still up 26.7, so almost third highest gain despite having a bad quarter, the last one. And real estate, of course, is leading the last 12-month tally. Public sector enterprise stocks, metal stocks, PSU banks, commodities, all going down, which is not very good news in the sense that defensives were leading along with auto, and the high beta stocks were going down. So there is potential that the market may crack down in coming sessions. Pharma, as I mentioned, led by Ajanta Pharma, 9% gain today. Glenmark Pharma, Laurus Labs, Dr. Reddy's, Ipca, Abbott Labs, all making substantial gains. And you can see the chart also on the pharma index is looking quite healthy, looking for a new all-time high soon on that. Stock spotlight is on Acom's Drugs and Pharma. This is a recent, I would say, a IPO had fallen from 1150 to almost 500 rupees, and now starting to go up 10% for the day on this. So let's now come back to the topic of the day, warning from index rebalance. Let's see what this means. So index re-ranking of Nasdaq 100 is what we will discuss today. Every year, Nasdaq 100, which is the most popular uh, technology and biotech index in the US, goes through a rebalance. Unlike Indian indices, which go through a constituent change every 6 months, most of the US based indices do this only once a year. So in December last week, the Nasdaq 100 is rebalanced, and with change, the changes are reflecting basically the dynamic nature of the market, the changing in nature of the stocks in play, and importance of adaptability of the current situation in the markets. So the exits are Illumina, Super Microcomputer, and Moderna. This in this last 1 year, when now that we are doing the rebalance in December 2024, these three stocks have gotten exited. Now you can see these stocks and see what is the pattern here. Illumina, which is down 75% from the peak, is getting exited. Super Microcomputer, which is down 72% from the peak, is getting exited. Moderna, which is down 92% from the peak. It was nearly 400 plus rupees as recent as 2021-22, and it is down 92% from there. If you will recall, this was the great stock post the COVID run. It went up from $10 to almost 400 plus dollars, and now it is back to 40. And this is now getting exited from the index. Of course, a lot of momentum strategies probably would have exited it much earlier. What is entering? Palantir is entering, MicroStrategy is entering, and Exxon is entering. Now let's see what these stocks are doing. Just look at Palantir, how it has done in the last 2 years, going from $6 to $82, almost a 15x rise, 13x rise since 2023. MicroStrategy, which had fallen dramatically in 2001, 2002. After 2 decades, is making a comeback. It is up 26 times since this low in 2023 of around $15, and now it is $341. Exxon Enterprise is up 17x since this breakout happened, and in the last 1 year is about 4x or so up. So, what is common with stocks that are moving out? All of them have got thrashed. What is common with stocks that are moving in? All of them are doing very well. So, essentially, what is happening? The market is recognizing stocks that are doing well and which are winners, and where the momentum is strong on the upside. The market is rejecting stocks that are beaten down or have been thrashed by the markets and have probably have bleak future ahead of them. Now, the index, because of its nature of having a rebalance once a year only, can be very late. For instance, in these stocks, if this rebalance would have happened 9 months earlier, maybe a lot of the pain from this would have been avoided. If you had gone a year before, in let's say even in Moderna last year, I mean 9 months back, this stock was at least at 100 plus dollars. Now you're exiting it at $40. So index rebalances are often very late. In the Indian context also, I remember when Yes Bank was dropping from 400 rupees to 7 rupees, the index eliminated Yes Bank from its constituent at 21 rupees. So the index constituent remained invested in Yes Bank. So anybody having an index ETF, anybody investing in index mutual funds would have had compulsorily to be with Yes Bank from 400 to 21. But had they been with any active strategy, they would have probably gotten out at 250 or 300 or somewhere near that. So this is the difference between how index is extremely late to all these changes, while active strategies can do it much earlier. But nevertheless, the index inherently is following a momentum strategy. This is very clear. It is prioritizing high performing stocks and replacing weak stocks. So this, while it is a slow process in the index once a year or twice a year, but still it is following the basic tenets of momentum, which is to ride the winners and to get rid of the losers. So markets basically constant reviewing of your portfolio, more active involvement is required because the markets are evolving very, very rapidly. You cannot wait out a year, like in this case, or in 6 monthly rebalance cases, like in the momentum index 200 that we have in India, or Nifty stocks, or CNX 500 stocks, because yesterday's leaders may lag very, very fast these days. You cannot wait 6 months for that rebalance to happen. And these are, very, very key elements of momentum strategy is to exit at the right time and not have a very, very delayed outcome of this process. So buy and hold, in my view, does not fit today's dynamic market, because we are in a very, very rapidly changing market. I mean, there are stocks which have been doing very, very well, but then, very suddenly within a few months you will lose almost all the gains on that. So those kind of things are critical in terms of the rebalance frequency, and the buy and hold era seems to be history right now. The point remaining that because of technology changes, because of disruption in the market, this entire world is a very disruptive world. So the average age of a index constituent has dramatically dropped in the last many years. And for S&P 500, which used to be more than few decades, is now just above 12 years as per some study recently. So discarding weak performers, adding strong performers is the way to go forward, and that's how the change that is happens in the indices is able to keep the index relevant. So for instance, if you see the top 10 S&P 500 companies, you will see that in the 4 decades that are displayed here, very few companies will be overlapping, right? So I mean, for instance, in 1990s you did not have let's say Nvidia there, right? Or you did not have even Broadcom, that is there now, but you had Merck in 2000s, which is not there now. Or you may have had Coca-Cola in 1990s, which was not there. So this importance and relevance of each stock will change from time to time. In our case, maybe even stocks like JP Associates, even stocks like India Bull Housing, they were part of the Nifty at one point of time. But Yes Bank was part of Nifty. IVRCL was part of Nifty. Nobody talks about those stocks now. Unitech was part of some major index earlier. So there is a constant change that is happening, and you have to change with that. So the change is the only constant, so as to say. Do let us know how you like this content. What is your view about this index rejig business and active strategies to stay with the strength in the market? And thank you for watching. Please like and share these videos with your friends and family, and subscribe to the channel. Thank you.